Okay, so let's go ahead and get ourselves going again. So I want your permission to do something, and I don't think anybody's going to complain about this. Typically, in this discussion tonight, I would continue on and talk about some of the scale assumptions we're making, and I'm going to do that. We need to have them. But then I would go ahead and venture into how we change the returns to scale and how we make some adjustments to the forecasts. You will notice that I think it's the next Excel assignment has both a forecast with adjustments and forecast without. I'd like your permission to extend some of that and have your next Excel assignment be without adjustments. So it's all based on constant returns to scale, which means there's a group of assumptions that you don't need to spend time learning about tonight and that I'm going to push off for a week. Is that going to cause a problem for anybody if I do that?
No.
Taylor's sitting there thinking, are you out of your freaking mind? Of course it's not. In fact, just give me your American Express card number, Taylor. That'll do fine, right? Okay. So I'm going to have to make a couple of changes in some of the assignment due dates. So if you've been kind of scheduling things, give me a little bit of latitude. It'll take me a day or two to kind of make some changes in the assignments. I knew that in this setting, given not only the digital environment that we're kind of consigned to, but also the makeup of some of the things that we're dealing with in some of the material, I knew I was going to start to stretch some issues. And so rather than give you yet more heartburn than is necessary, I'm probably going to finish things off a little bit shy of where I would have for the semester, but I don't think you'll have lost anything of real value. I think I'll be able to get all the very valuable elements into this. And so just kind of flow with me if you would. Fair enough? Okay. All right. So I want to think about then a little bit more along this lines of what we're constructing here. Let me show you some of what we got going up on the top here. You understand what we're putting down here. We're just doing a year-by-year forecast.
Are you sharing your screen?
Oh, I'm sorry. Thank you. Of course I can. A little bit better? Okay. So I've got my base year. I've got my explicit period years. I've got my continuation year. I've got revenues. I've got the various expenses. I calculate EBIT. I can go over here and think about having forecast net working capital and fixed assets, which then lets me calculate invested capital. EBIT let me calculate no plat. So I know no plat and I know invested capital. I know return on invested capital. And when I have all these elements, I have free cash flow. And if I have free cash flow, I'm one of the happier guys on the mountain because I have what I need, right? I need a few other things. I need to have a long-term growth rate. Well, I have that from my financial statement. I need my tax rate. I have that from my financial statement. I need WACC. I have that from my financial statement. I need ROIC, which is from my financial statement. And then I've got these two funky little variables here, KU and K-tax. I'm going to ask you to ignore them tonight. They'll be important to us at another time. They're not important to us tonight. They are forms of a discount rate used expressly for a model referred to as the adjusted present value model, which we're not going to deal with tonight, and we'll only start to deal with at the end of next week. Okay? Over here, I have my long-term debt from 2018 and 2019. You'll see in a moment why. And those are coming off of the balance sheet from my financial statement. I've gone ahead and I have forecast some revenue increases based upon getting the best minds that I know to help me forecast them. And I have those in yellow because those are original entries. Okay. Now I've also put in yellow these headings, but I only did that for a descriptive purpose tonight. I normally wouldn't have those. I just need you to remember Some things need to be forecast and some things are calculated. You know that EBIT is calculated. I don't want you to forecast it. If you tried to, you would find in this environment that it is moving forward at the same rate of sales. Okay, that's coincidental because we're in a constant returns environment, but it happens to be the coincidence that we're living with. And then we've got this interest expense category, and we've got this debt category. So I want to stop and think about why these are here and how we get them, okay? Well, I take interest expense right off of the income statement in my base year. So this number came from the income statement. But I want to have a ratio for interest expense as well. How did I get the ratio for my regular expenses? Bella, how did I get this 53.65% ratio of production expenses?
You divided production and services by revenue.
Love it. That's exactly what I did. I did it for my base year. What would happen if for some reason my base year's production and service costs were abnormally low? Will I still only use the base year to get that ratio?
Yes.
I could, but if it was abnormally low, now I'm going to be forecasting, I'm going to under forecast the expense for a future year, aren't I? So if I know that I have a period here that has an either unusual revenue cycle to it or an unusual expense cycle, I might not take my ratio simply from 1 year in the past. I might take some averages from years in the past so that I don't give myself a forecasting problem moving forward. So here I'm giving it to you from on a 1 year basis, but I could have just as easily taken the average of the production and service expenses for the last 5 years and divided it by the average revenue for the last 5 years, and maybe that would have given me something more reliable if I thought I had an anomalous period that I was having to account for. Does that make sense? We smooth over anomalies by taking averages. We smooth over anomalies by taking averages. Okay. Debt and interest are correlated, aren't they? Do you remember one of the inferior ways of calculating RD? We know that the best way is to find the current yield. So what it would cost the company to have that type of debt in the market today. What was the next best way? Any recollection? And I don't need you to go back through your notes. If you recall it, great. If you don't, I'll show it to you. It is, look right down here, it is interest paid at a period divided by the debt from the prior period. So interest paid for a given period divided by the debt from the prior period. That's an inferior way of calculating RD if we don't know the current yield. We more often than not know the current yield. It's pretty easily gotten to, okay? Well, as it so happens, that is the forecast ratio for an interest expense. So if I know the prior period's interest expense, or excuse me, prior period's debt, and I know I can calculate the interest expense for this period. Because remember, just like with forecast ratio for OPEX and trying to turn that into a model to calculate or forecast OPEX, I can rearrange this equation and I can say if I know the debt and I know the forecast ratio, it'll give me the estimated interest for the next period, right? Why is it that we use the interest from this period against the debt from a period before? Why don't we use the interest from this period against the debt from this period like we do in the OPEX scenario? Why do we have this one period temporal shift? Kylie, do you pay interest on anything? House, car, student loan, diamond ring?
Oh, student loans, I guess, yeah.
Do you pay interest on your student loans based upon the balance that you're going to have for this month or based upon the balance you had last month?
The balance I had last month, actually.
Exactly. We always pay interest in arrears. That's why. Okay. That's why it's a credible way of calculating RD if you don't know current yield, and it is the forecast ratio for interest. So I'm going to think about forecasting interest because I know it's on the income statement, but I'm also going to get to a point where there's a model that I use. It's that little adjusted present value model I referenced a moment ago, and it requires that I have the interest expense. So I've got to forecast interest expense. It's got nothing to do with free cash flow, does it? Nothing at all. And because I'm going to need to forecast interest expense for that model, I have to forecast debt. Because remember, the interest expense for this year was based upon the debt from last year, right? So when I go ahead and use this, I create a forecast ratio. And that forecast ratio is the interest from my base year divided by the debt from the year before. Interest at 1 divided by debt from 0. Or interest at t divided by debt from t minus 1. Means the same thing. Which is why I have both 2018 and 2019 debt up here. So I can then think about that ratio. Okay? And once I know that ratio, I can forecast the interest expense for the next period by taking the prior year's debt. In this case, I'm looking for 2020's interest. So since it's a prior year, I'm taking the 2019 debt. I'm interacting it by the ratio to give me the 2020 interest expense. And I would use that interest expense if I was trying to calculate taxable income or net income, or as it turns out, if I'm trying to calculate the adjusted present value model, which we'll come back to another time, not tonight. Well, how do I calculate debt? And I see debt on the income statement, or rather, I see it on the balance sheet. I know I got it from my balance sheet for 2019. I got it from my balance sheet for 2018. How am I going to forecast debt? Any ideas?
Depreciation?
Pardon me?
Looking at, I don't know. I was going to say looking at depreciation.
No, depreciation is going to be a non-cash expense that I use to recognize the reduction of value of tangible assets. And so I won't use that. And typically, I am not forecasting it based on what I paid off.
Oh, invested capital.
Well, I might have to think about invested capital a little bit. I know that debt is one of the two components of the finance approach to invested capital. Okay? Well, that's good. That helps me. And I appreciate you pointing it out, Bella. How did I forecast my invested capital already? I used the ops approach, right? But I forecast it by having forecast fixed assets and net working capital. And then I calculated invested capital. So I forecast the operational components and then I calculated invested capital. But I know that if invested capital in the ops approach and invested capital in the finance approach should be the same number, then I should be able to use the same overall methodology. And the methodology I used to forecast the components were I increased them at the rate of increase of revenue. So methodologically, if I'm increasing fixed assets and net working capital, which equal invested capital, if I'm forecasting them, estimating them as growing at the rate of revenue, then any other component to invested capital would also have to grow at the same rate of revenue. So how do I grow my debt? Well, I kind of did it at revenue, and I kind of didn't. You're going to get mad at me for a minute. Okay? I'm actually using another ratio that I've created, a debt to invested capital ratio, which is simply calculated by dividing debt by invested capital. There's a relationship that we find in companies, And it does happen to correlate with this growth of revenue in a constant returns world, but only in a constant returns world. And that relationship is most companies tend to have a constant relationship between their long-term debt and their capital assets, which means they've gotten used to having a certain amount of leverage that they use to acquire those capital assets. So this ratio, debt to invested capital ratio, is what I'm going to use to identify my debt. So my debt for 2020 is that ratio, which I believe is a constant, times my invested capital for 2020. So I employ it as a model, just like I employ the forecast ratios otherwise, don't I? It's a ratio. It's kind of a forecast ratio. It's technically not called one, but it's kind of a forecast ratio. It's technically a capital ratio.
Hey, Rick, just a quick question about that term you use, leverage. So debt to invested capital ratio. If that ratio continues to go up, that means your debt is getting closer to the equaling the level of your invested capital. Is that what people mean when they say somebody's highly leveraged? You're getting closer to equilibrium in that ratio, or closer to 100%?
That's an interesting question, Matt, and I'm glad you asked it. So in this case, the debt and the invested capital, since debt is based upon invested capital, they're changing at the same rate. So I would keep a consistent relationship between debt and invested capital. In this case, it's 23.94%, 24%. So as my invested capital is rising, my debt is rising at the same pace. So they have the same relative relationship. And all that means is, as a company, we've evidenced that we're comfortable financing at some level our new capital assets, which capital assets we use to create revenue.
Right. So it's a ratio no matter what. The percentage is just whatever it comes out to, because the debt is what feeds your invested capital.
Yeah, and in this case, what we're saying is we're buying some of our capital assets by taking on more debt. So as our capital assets are growing, some of it's being financed by internal capital, retained earnings, cash, etc. Some of it's being financed by debt. And that happens to be a consistent relationship amongst the 108 firms in the Dow 30 and S&P 100. I say 108 firms because of those 130, some of them are overlapping. Okay, if you take the 30 Dow Industrials and the 100 firms in the S&P 100, some of them are overlapping. There's 108 companies there. But they have a remarkable correlation. As invested capital rises, debt rises as well. So this ratio is exclusively for the purpose of forecasting debt, which is exclusively for the purpose of forecasting interest expense, which is exclusively for the purpose of forecasting net income if we wanted it, and forecasting a value using that adjusted present value model that I will teach you in a different week. Does that make sense, and could you replicate that? Here's my guess, is if you had to do this off the top of your heads, you would have a fighting chance at about 80% of it, and that other 10% is going to come by reviewing videos and asking questions. Okay? Let's go to this one last item, and then that'll be the end of this part. I also have an invested capital to revenue ratio. Invested capital to revenue, which I got very similarly to the way I got the debt to invested capital ratio. I simply am taking invested capital for the base year, dividing it by the revenue for the base year. Let me show you how I'm using it. Notice that I didn't use it to calculate my invested capital. I took my net working capital and my fixed assets. But if you go all the way over here And you're not responsible to create this column. When you see the assignment in Excel, you are not responsible for either of these columns, okay? But I have them because I use them for different purposes. I want to make sure when I'm calculating my invested capital using net working capital plus fixed assets, I want to make sure that I have not messed something up, because if I have, it's going to have an adverse effect on numerous other calculations down the line. So I calculate invested capital two ways. I calculate it as the operations approach, and then I calculate it using a ratio. Which ratio is, remember this D13 and I8. Well, D13 is right here, revenue, and I8 is the invested capital to revenue ratio. So if I know a year's revenue, and if I know the ratio, I can solve for invested capital, right? If invested capital to revenue equals a ratio, then revenue times that ratio equals invested capital. And so I use this variable, or this constant ratio, which by the way is a constant returns to scale assumption, and I use it to double check my invested capital calculation. You are welcome to do that. I don't hold you accountable for doing it, but you'll see it on my spreadsheet sometimes as we're working together, and I wanted you to understand it. You are accountable for the creation of this ratio, but that's easy. It's the revenue, or it's the invested capital for whatever that base year is, divided by the revenue. Any questions about where we are?
So I guess I had one question on the interest expense, because do you want us to do the net working capital plus the fixed assets, or do you want us to do the prior debt times the ratio?
So the interest expense is going to be a function of the prior year's debt and the interest ratio. Okay?
What was the one that you just had that was net working capital plus?
That's invested capital.
Oh, invested capital. Okay, sorry.
Net working capital plus fixed assets equals invested capital. Okay? So with all of this, you can forecast out all of our free cash flows. Oh, you're not forecasting the base year. You're taking it from the financial statements, right? And technically, you're not forecasting the explicit period years. You're simply calculating. By the way, I should have made that yellow for you. And we're also calculating ROIC. We're not forecasting it. We're just calculating. Okay? And we're calculating free cash flow. We're not forecasting it. But we're forecasting all of their inputs. So I guess in a two-stage structure, we're kind of quasi-forecasting it, right? But I want you to notice something. We have this smoking hot growth of 31%. And our free cash flow, it's growing. It's moving along. And then it explodes. That's hot, right? Because remember, in the Gordon growth model construction, I take the free cash flow from time one, which is the first year after the explicit period, which is what this year is. And I divide it by the discount rate. Michael, I am so curious as to which has you grinning so broadly, but you don't have to tell us it's contagious for half a moment, okay? So in the Gordon growth construction, that continuing value is predicated on this projected, calculated, estimated, forecasted, projected free cash flow. And when that number is that big, our continuing value is going to be massive, isn't it? Massive. How did we go from these little movements each year to boom? What's going on there?
It's weird. I don't know. Like, it's counterintuitive to me because you're going from the 31% to the long-term growth ratio, aren't you, on that
2.5%.
last year?
So we slowed down our growth and our invested capital grew. Or excuse me, our free cash flow grew, right? We slowed down our growth. We no longer needed to commit as much of our resources to the growth of our capital assets. Remember, free cash flow is no plat plus depreciation, and then this net capital spending and net working capital variable, those are changes, and we're committing some of our EBIT and depreciation to those changes. That's why there's subtractions, right? So we're committing some of our EBIT and depreciation to those changes in capital assets, and we call that free cash flow. When the change in our capital assets slows down, and we know they slowed down to the same rate as revenue, went from 31% growth to 2.5%. We know it slowed down. It slowed the drain on free cash flow. So all of a sudden, all these years of growing, investing, building, developing, growing, investing, and building starts to pay off in a big way. That's what's going on. Does that make sense? I want you to think about this from one other standpoint as well. Let's make an assumption that these earlier years, the base year, 1, 2, 3, 4, maybe even year 5, could possibly have negative free cash flows. And the next year, it could be nicely positive. Because these years had negative free cash flows, would that mean the company is losing money? Does negative free cash flow mean the company is losing money?
No.
You're right,
If
Jason.
they're investing in, they're investing in themselves.
They're investing in themselves. Now, if we have a negative EBIT, is the company losing money? Yeah, it's got a negative operating income. We've got a problem. Now, it's okay to lose money, even to lose money on operating incomes when you have a very early stage company, right? Most early stage companies lose money and they have negative operating incomes because they're just getting their processes in play. So that's okay, but we only let that happen for so long, and if management doesn't correct that, then we either close the company or we replace the management, right? But if we have a company with a positive EBIT, but that is investing heavily in its capital assets, which means it's investing in next year's revenues, it's going to end up having very possibly a negative free cash flow. All of these unicorns that you hear about in the private capital world have massively negative free cash flows. Tesla, and I dig Tesla as a company. Maybe not as much as an investment, perhaps just because of my risk quotient at this point, but I dig Tesla as a company. And Tesla barely knows what a positive net income means. Tesla barely understands the word profit. They almost always have loss and massive losses, right? But recently they've started to realize what the word profit means because their shareholders have forced it on them. And even in the midst of that, their growth has been such that their free cash flow is massively negative. As an investor, believe it or not, I prefer a positive EBIT, nice operating income, and a big negative free cash flow, because it means that the company's being able to put capital assets at play to create more operating income. That is kind of nirvana or a sweet spot for an investor. I don't like negative operating income. I dig negative free cash flow.